In the past year or two, global financial circumstances have led to a noticeable increase in available funds for many individuals due to various stimulus programs and quantitative easing, among other reasons. Even though this might be the case and has affected people worldwide, individuals are grappling with reduced purchasing power, higher mortgage costs, and difficulties in saving. The average interest rate on a 30-year mortgage more than doubled, reaching 6.69%, resulting in an additional monthly payment of $1,260 for the average mortgage size of $425,000. Furthermore, the personal savings rate in the United States hit some of its lowest levels in approximately 15 years, indicating the challenges individuals face in increasing their savings. While the Federal Reserve aims to control inflation and maintain interest rates, the future trajectory remains uncertain. Hello and welcome back to another video on our channel, Finance Sense, covering all the latest trends in the financial markets and the economy. In this video, we'll be shedding light on the underlying factors why we still feel broke even though we have money. Factor number 1. The COVID-19 pandemic was not only a dreadful moment for humans in general, but also a historically significant economic disaster. People were placed under lockdown, factories and ports were shut down, and productivity plummeted. The manufacturing sector as a whole saw a decline in output. As humans, however, we continue to consume, and when the supply of products and services is low but demand is constant, inflation occurs. When the pandemic first started, inflation dropped, but when shortages and shutdowns persisted in 2021, prices rose sharply. This was due to a number of causes, including the US government's astounding stimulus program, in which the Federal Reserve printed new money and then distributed it to citizens through the Treasury. Then China, the world's largest producer, was shut down entirely. Finally, Russia invaded Ukraine. In terms of checks for the stimulus package, more than 476 million payments with a total of $814 billion were distributed to families struck by the pandemic. However, when the stimulus checks were sent, consumer spending quickly recovered as the ordinary American saw a significant increase in savings. Unfortunately, this occurred when many industries in China and other countries were still closed. About 1/3 of the world's manufactured goods come out of China. They did, however, experience a very stringent lockdown that went on for a very long period and significantly impeded the movement of products throughout the globe. For instance, Shanghai, home to the world's busiest port, was jam-packed with ships eager to fill up with cargo in the hopes of transporting those items to other parts of the globe. Then, when Russia obstructed Ukrainian ports, a European land war occurred, disrupting energy delivery to Europe as well as significantly reducing the global supply of wheat. Meanwhile, at its peak, US inflation reached 9%, and while it is presently dropping, it is twice the Federal Reserve's goal. Inflation can be measured by the growth or decline in the Consumer Price Index, which is simply an index that measures a basket of household goods and services. It includes necessities such as housing, transport, food, medical treatment, and so on. If you compare the current level of the CPI to where it was before the pandemic began, you will notice that the price of this basket of commodities has increased by 17%. In other words, if your monthly living costs were $3,000 before, they will be $3,510 after 3.5 years. Unfortunately, considering today's inflation rates, the same basket of items continues to rise by 4% annually. Factor number 2. Interest rates. Now, most countries or regions have a government and a central bank. And even though these two things are not dependent on one another in any way, shape, or form, they have a very strong working connection in order to get the greatest results possible for the economy of their respective countries. The government can increase interest rates as inflation increases. When interest rates are raised, inflation falls. But they don't tell you that when they raise rates. Your interest rate on loans like mortgages and car loans also rises. Since there is no causal relationship between interest rates and inflation, they intentionally increase your car payments to reduce your discretionary spending. The way it operates is that they raise the cost of servicing loans, including your own debts and the debts of corporations. Given this new financial reality, it will be necessary to make some sacrifices. However, the government has been approaching its debt limit, meaning it cannot afford to continue spending at the current rate. Indeed, Congress recently suspended the debt ceiling until 2025. However, to achieve this, Republicans exerted pressure on Democrats, resulting in an agreement to restrict spending. Consequently, citizens will not reap the benefits they were anticipating. As an illustration, within the bill, unused funds allocated for coronavirus relief were withdrawn, and additional work requirements were imposed on programs such as the Supplemental Nutrition Assistance Program and the Temporary Assistance for Needy Families Program, thereby increasing the difficulty of accessing these programs. Additionally, the suspension of student loan repayments has concluded. As a result, we're currently mired in a difficult situation, with the cost of living increasing by 17% since before the outbreak and mortgage holders paying double the interest rates, with no relief in sight from the government. Examining the personal savings rate in the United States, it is evident that 2022 and 2023 have witnessed some of the lowest savings rates in approximately 15 years. The data clearly indicates that U.S. citizens are currently facing significant challenges in augmenting their savings. However, considering the situation, what can we expect in the future? Historical evidence suggests that implementing measures to control spending and maintaining high interest rates temporarily is a far more favorable outcome than allowing inflation to persist unchecked. Numerous instances of inflation have escalated to hyperinflation, ultimately resulting in the devaluation of currencies, as seen in Zimbabwe. Hence, the Federal Reserve is vigilantly monitoring the inflation rate, keeping interest rates relatively high, and ensuring that inflation returns to its targeted annual rate of 2%. If this occurs, things will gradually improve. However, the situation will worsen if inflation fails to decline as desired. Presently, inflation is actually decreasing. It has been steadily declining for approximately a year, and its decline has been consistent enough that, during the recent meeting, the Federal Reserve chose not to raise interest rates any further, at least for the time being. Jerome Powell, chair of the Federal Reserve, stated the following: "In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged." Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. Thus far, the prevailing trend has been a series of interest rate hikes. So it is indeed promising that the Federal Reserve currently believes there is no immediate need to raise rates. However, this situation relies on inflation continuing to decline. In its most severe state, inflation reached 9% in the US last year. Currently, it stands at 4% and is progressively decreasing. However, realistically, this still exceeds the Federal Reserve's desired target. If inflation now plateaus instead of returning to the 2% mark, it can be expected that the Federal Reserve will implement further interest rate hikes to prompt a decline in inflation once again. It sounds like we've reached the end of this video. If you found this video helpful, please hit like and subscribe, and comment down below your thoughts in the comment section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you next time!